Welcome to the Alternate View. Today we have a great guest here. Vik Uppal from Mavik Capital will be here with us today. Really super excited about discussing his environment in the structured finance space around real estate. So I'll jump right into it. Vik, thank you for spending some time with us today. Hopefully our listeners and viewers will get an understanding of kind of what you guys do and the asset class itself, which is kind of under the radar as we were talking about. So thank you. Why don't you take a couple minutes and give us a little background about yourself and your firm, and then we'll jump into some questions.
Yeah, sure. Well, it's great to be with you. My name is Vik Uppal. I'm the founder, CEO, CIO of Mavik Capital Management. We're an opportunistic investment firm, really focused in, middle market real estate credit. Our investment strategy is a very kind of flexible, nimble, look for the best relative value. So we're investing across property types, markets, securities. Our business today is, we manage about $1.5 billion of capital. It's a very active strategy where we're, out there finding, kind of unique opportunities, things that are highly, highly structured. We've been investing since, kind of 2009. So I've invested throughout kind of different periods of time, different climates, high interest rates, low interest rates, high inflation, low inflation. And I think, when you look at our strategy, there's a level of kind of consistency to what we do, regardless of whatever the environment is. And, a little bit about my background. So I, started my career as a real estate operator developer. So I actually have, a lot of experience building, managing real estate really on, kind of the front lines, which I think really helped me tremendously because I understand, how things are actually put together and are built and are leased. And so, a lot of our business, while we're, financial investors, but I think also understanding how something works operationally is, kind of incredibly important. From there, I moved to the institutional side of the business. I worked at a firm called Mount Kellett, which was a spinoff of Goldman Special Sits. Yep. At peak, it was an $8 billion business investing in kind of all asset classes throughout the world. I co-headed U.S. real estate there. And early last cycle, there was a lot of distress, bankruptcies, restructurings, which is a lot of the kind of core competency. And then, as the cycle evolved, it was, buying more mismanaged, miscapitalized assets. And then from there, I was a managing director at Fortress and their, the real estate and their credit funds. And that really shaped a lot of my thinking in terms of, how you manage risk, how you look for opportunities that might be more differentiated. They have, a lot of downside risk mitigation and margin of safety. But what was interesting to me when you're at, kind of some of these larger firms, which is, what made them really great in the early days of their life cycle, which was prioritizing performance. The team had the right type of incentives. You had, these great deal makers that were on the front lines. As those businesses now have become much more mature, their focus and their priorities have changed. Yep. And really, so much of the focus for those type of organizations is unlimited AUM growth. So it's just, how do we keep getting bigger and bigger and bigger, and how do we try to get to, kind of the AUM Hall of Fame? Yep. And so if you see for most of these large firms, like that's what their priorities are. So I really wanted to create a next generation, investment firm where, the team had the right type of incentives. You had an investment strategy that's really be able to, to build to outperform. And the sole mission of the organization was outperformance. And so everything that we do, it's really with that in mind.
Yeah, we love the alignment of interest with your LPs as well as it relates to that. But, that's fantastic. We could have a whole nother conversation about size and funds and things like that. But let's focus on today in terms of real estate. Let's start there on the macro side a little bit, because I would say 10 years ago, the real estate environment looks very different than what it looks like today, right? I mean, we've had a lot of changes over the last number of years. Real estate, I would say, in general, on the commercial side especially, is somewhat stressed to an extent. And I'll let you dive into that in terms of where that is. But talk a little bit about kind of maybe where the real estate market is today and how you guys necessarily fit into that, and maybe what are some of the factors associated to that, where we maybe 10 years ago where we were versus kind of where we are in today's environment, right? I think there's a lot of different opportunities presenting itself today in the real estate environment relative to what it was probably 10 years ago.
Yeah, we're in a world today that things are changing very quickly, regardless of kind of whatever industry you're in. And I think commercial real estate, that is kind of a perfect example of, as you said, kind of 10 years ago, if you looked at the way kind of real estate was kind of transacted, if you look at kind of who the kind of capital players kind of were in an environment like that versus today, it's kind of shifted kind of so much. And I describe the environment, I would say, over the last 5 years as one where there's been, just a tremendous amount of uncertainty. And so if you think about, kind of going into COVID, kind of the way that real estate was the environment where you had, kind of a lot of capital that was, kind of chasing, real estate, both, kind of debt equity. COVID obviously very much disrupted, a lot of different industries, asset classes. And you see a perfect example of that is with office in terms of how space is used and how buildings are being leased. And then you've really seen kind of post-COVID, you had obviously kind of the environment change in 2021 where capital was a commodity. You saw kind of a lot of deal flow and things kind of moved in a different direction. And then all of a sudden things kind of turned around very quickly as rates started to go up and the environment shifted to one where you had just a tremendous amount of uncertainty. And so I'd say that's an environment where our strategy is really going to thrive when you have periods of dislocation. Capital is not a commodity, credit availability is low. And what you're seeing and why we're so focused in the kind of that middle market space is that for small to medium sized businesses, like they're the ones that are they're extremely active in terms of kind of demand for capital, but the supply of capital and kind of the pockets of opportunity there are just kind of very, 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 very high. And so again, I think an environment like now where there is a lot of uncertainty, capital is not a commodity. That's where our strategy really thrives.
Yeah. Speaking about that, I mean, we're in an environment where there's a capital need necessarily, right? Liquidity and access to capital, and especially in the middle market space that you're describing. How do you think we got to this point necessarily, right? Were some of these funds or developers or investors just over leveraged in this situation? Were they buying at too high of prices? Like, everything seems to be re-rating at the moment in terms of price, valuation. Obviously, you mentioned rate movements have been up and now down to an extent. So we're in this kind of weird environment. I'm just curious, like, from your perspective, what do you think is drawing this component of stress in this particular space?
Well, I think it's all of the above. I think what you saw happen is that there was so much capital that flowed into commercial real estate, and when that happens, that's when valuations go up. It leads to periods of oversupply. It leads to, in the way that you described, is people getting kind of over their skis. And I think that's where you saw that environment kind of over the last kind of 4 or 5 years, and a lot of those things are now reversing. And so somewhat is reversing kind of to the mean, but I think things kind of overshot so much that now they're going kind of in the other direction. And so one of the reasons why we've always subscribed to this very kind of flexible, nimble type of model is that we never want to have any forced investing. And I think the issue that you saw for a lot of real estate operators, developers, funds that they raise capital in a very kind of narrow box where they define we want to go in this specific market, this specific property type, but that's what leads to that kind of oversupply. It leads to the valuation issues, and that's what you saw happen. And so a lot of those trends now are reversing.
Yeah. And so with that necessarily, do you find that there's any specific asset classes within inside of the commercial real estate space or geographies necessarily that are more stressed than others?
Our business is kind of bottoms up where we look at everything on kind of an individual merit basis. So it's less about kind of taking a top-down view on one specific market or property type.
Yeah.
But I would say is real estate is a capital-intensive kind of debt-dependent asset class, and so one of the things people always ask us about is interest rates. How does that really impact kind of real estate valuations? That's one variable. But if you actually the other variable to look at is just credit availability, and so that's where you see credit availability today is much, much lower, and that's where a lot of the stress is really brewing, because for small to medium-sized businesses that cannot access capital, like, it's creating a lot of liquidity issues.
Yep. So banks, right? We have to talk about banks, especially big money center banks, regional banks. I mean, that had been the primary supplier of capital into these markets. Obviously, we've seen some banks default to some extent, right? With SBV and First Republic, which is, I'm assuming, putting a constraint. And then we have some regulatory issues with regards to the government and what they're putting onto banks. And obviously the lack of liquidity or ability to provide to these borrowers necessarily opens up a pretty significant market. Has that helped you guys?
Yeah, I think it's, and I was just kind of describing earlier, is like you have an environment where you have a huge imbalance between kind of supply of capital and demand for capital. And so if you look at kind of on the supply side, that especially for kind of small to medium sized businesses, right? So not kind of these larger businesses that have access to capital markets, like they're the ones that are seeing the most stress, where you have environment credit availability is low. Traditional lenders have pulled back in a really meaningful way, so capital is not available to them in the same way that it was kind of historically. And so from an opportunity set perspective, like I would say it's probably one of the best opportunity set that we've seen in over kind of 10 plus years, because you have very limited competition, yet the demand or the need for capital is just so high. And so in environments like that, where you have a lot of capital that's on the sidelines, there's tremendous amount of uncertainty. When you have kind of flexibility in terms of how you invest, like that's where you tend to find the best opportunities.
Yeah, and I want to be clear too. Like, you're finding opportunities regarding credit, right? There's some really good assets with some really good credit profiles. I'm assuming it's not just what people consider. I would say our audience would consider high yield or risky type of borrowers necessarily trying to like survive in this type of environment.
A lot of times when people look at our returns, they think that we're, kind of high octane, or we're doing things that we're moving kind of up the risk curve. So much of our business is actually spent on how do we avoid risk, right? How are we investing in places that either could be misunderstood? There's, some type of unique angle that people may discard for superficial reasons. And that's where, if you actually were in our kind of IC or in our pipeline, like so much of what we're talking about is how do we mitigate risk? How do we create structures that give us, the right type of downside risk mitigation, margin of safety, and provide us, kind of very clear path in terms of, return of capital and return on capital. Now, everything that we do, our, first priority is capital preservation.
Yep.
And so we're always going into situations saying, look, is there a kind of clear line of sight to how we're getting our money back? And that's by investing in situations where we have, significant amount of asset coverage. And we typically like to see, kind of multiples in terms of what our loan amount is. And the second is that, we want to see a majority of our portfolio return coming from current income. And we think that's a, very predictable way to invest, and it's less correlated to the macro environment, to commercial real estate markets, and even to credit markets. Yeah. Because when your economics are tied up all in the back end, you're just so much more susceptible to things changing. Yep. And so the thing that we focus on is how do we have a level of predictability in the things that we invest. Now, yeah, a lot of the situations that we're investing in, there's some level of kind of complication or something that may be misunderstood, but we're trying to kind of uncomplicate those situations by creating structures that give us a lot of predictability.
Yeah.
And so it's not about kind of high octane or things that may feel like they actually have a lot of risk. It's much more about investing in situations that provide you a lot of certainty.
Yeah. And I'll ask you some questions about structure in a minute, but one thing, obviously there's two more I want to ask you about regarding, does the environment necessarily change as interest rates get lower or potentially get lower or stay the same? I mean, are we going back to a lower interest rate environment, which people can kind of kick the can down the road a little bit? And then with that, I'm going to, fold in the political component of it. We're not political here. We're not making any decisions, but just from the regime component, does it add, you said there's a lot of moving parts. Well, there are, right? Rates, and you have the political landscape, and then you have a variety of other things going on. But just curious, from like, as you look at the space and you look forward, are those things impacting what your opportunity set is, or do you feel like comfortable around that?
Well, I think as a kind of a opportunistic investor, and like while we look at everything on a bottoms up basis, I think you also do have to have some view in terms of macro and understanding kind of where trends are and all the variables that you have to manage. And the political risk is kind of one of those. I think what you've seen now happen is that a lot of the overhang that was kind of in existence this year, now there feels like there's just much more certainty and kind of path in terms of kind of the next 2 to 4 years, that I think for a lot of investors removes that kind of one variable that was obviously highly kind of uncertain.
Yep.
But that being said, is that while one variable has been removed, I think you're still in a time where, especially in commercial real estate, where there's just a lot of things that are uncertain.
Yeah.
Right. You said rates. You've had there's so much anticipation that rates were going to come down this year, and then they started to move kind of the other direction, and now they realize nobody knows. Right. I mean, what's going to happen over the next 6 to 12 months, and our business, which is a very active business, you have to keep your eye on the ball kind of all the time, and you have to be be able to be flexible and nimble and agile as some of the variables change. And that's why we've always believed so strongly in having the flexibility to invest, because if one variable changes, then you can pivot and you can focus on the best opportunities.
Yeah. I mean, we've seen the banks kicking the can down the road a little bit. You've seen that maturity wall keep on like moving outwards. I mean, and getting bigger in essence. And it's kind of like, extend and pretend for as long as they can. Like, how long does that happen? We've seen defaults kind of tick up a little bit, but we haven't seen anything significant, I would say. Does that change? Did we see that change?
You haven't seen it significant that's led to huge levels of distress. I think
Yeah,
what
right.
you've seen is that there's a lot of, kind of stress, liquidity issues, like the need for more restructuring capital,
Yeah.
restructuring capital structures. And so I think the need for, that is really, really high. Now, typically those situations, an environment like we've seen over the last few years are very friendly, where you're coming in and you're providing kind of very tactical capital that's needed for both operators, for banks, for, kind of debt funds that may be dealing with, kind of liquidity issues. And so these are, kind of negotiated transactions that you're providing more kind of capital solutions. And
Yeah.
the thing that we really like about that, and this goes back to my earlier comments, is that there's a level of predictability in terms of the things that you're investing in. So
Yep.
even if they may feel that they're complicated, you're actually kind of uncomplicating them, and they're actually just very simple to be able to understand how you make money, how do you get your money back, and that's why we think the environment for what we do is so interesting.
Yeah. So let's talk about structured finance just in general, and I'm going to have you step back because I know you're, very smart around structured finance, but just explain structured finance just for the folks that don't necessarily understand. I know you were trying to pull in some examples today, and talk a little bit about the opportunistic nature that you're delivering relative to those groups that are, they stay in one single lane, right? I think that's important along with that, in terms of what you guys do.
Yeah, so if you look at what most funds operators, what they typically do is they define, kind of a very narrow box of what they invest in. So we invest in this industry, this property type, this market. So it's easy to raise capital because you can say, I can understand exactly what you do.
Yep.
But the issue with that model, it goes back to the earlier comments, is that it leads to excess. It leads to people getting kind of over their skis, and it really leads to a lot of forced investing. And so our view is that we don't want to have those type of constraints where we ever have to force anything. And so one of the things that by design is that we have a very flexible investment strategy. And so what that means is we invest kind of across the capital structure, but we're looking for the best relative value that kind of meets our standards. So that's investing in situations that, kind of a huge amount of downside risk mitigation. There's clear line of sight to how we're getting our money back. We're investing in situations that have kind of multiples in terms of, kind of asset coverage. And then, again, that, there's a level of, kind of current yield that's driving a majority of our, kind of return. And so, we think that type of philosophy, obviously it works and really thrives in periods of dislocation, but that's a big part of, kind of how you outperform. Now, the other point is all of our transactions are highly, highly structured. And so we're going into situations and, we are kind of a very patient, disciplined, wait for the right pitch. And a lot of that is, we're looking for situations that we can create the right type of structure that gives us the downside risk mitigation that we're looking for.
Yeah, so your risk-adjusted returns, or you're looking at whatever the situation is in general and determining where you necessarily need and what you need to get for a return relative to that, whether it's on the top of the stack in the senior secured position or down into the equity, which, that varies, right, in terms of, and then how much, right? You have the ability to do a little bit more than what traditional it says, I only do senior secured, or I only do mezz, or I only do, pref,
And you
or
would be
whatever it
amazed
is,
at
right?
how many deals get discarded because they don't fit exactly inside those kind of perfect boxes. So it's that,
Yeah.
well, look, you have this deal, he comes to you and says it's, kind of, yeah, it's either too small or that the exact, structure may not work, and then it gets discarded. And so for a lot of our larger peers that, they invest across the capital structure, but they have, multiple funds, they have different teams that work on different funds. A lot of times you'll see things just get discarded because they don't fit within those boxes. And because the fact that we can look at a situation and say, what's the best way to invest here,
Yep.
right? Is it a first mortgage? Is it sub debt? What's the right way to structure something? And that gives us a lot of that flexibility that we can actually, create the right type of structure versus we have to force something and then we're kind of back solving.
Yeah, so you can solve the problem for the borrower. It's
could
basically
solve- you
the
could
one-stop shop, right?
Exactly. You could solve the problem from the borrower, or you can look at a situation and figure out what's the best structure. And what's interesting about the environment today is when you see a lot of the kind of traditional lenders, banks, other groups that have pulled back so much, is that a lot of the deal flow that we're seeing is deals that would have traditionally went to banks. And they would have went to more traditional lenders, but because they pulled back so tremendously in their commercial real estate, lending, that a lot of those deals now are going to groups like us that we're able to take almost bank-like risk, but we're generating equity-like returns. And I think that equation is so interesting and compelling for kind of what we do.
Yep. And now, obviously, we talk stress, distressed. Like, give me some example of that relative to what you're seeing, I guess, today, or what you have seen over the last year or so.
Well, there's a lot of reasons why situations can be stressed, right? It could be a fund that's kind of at the end of its fund life. It could have liquidity issues. It could be a real estate operator developer that's kind of asset rich, cash poor, and is also having liquidity issues. It could be kind of the kind of classic case of kind of good asset, bad balance sheet, and I'd say that's what we're seeing a lot today, which is kind of the need for kind of recapitalizations, restructurings, where you have deals that were done in a very different interest rate environment when valuations were also much higher. And a lot of those deals now, they're either, to your point about kind of the wall of maturities, that as those are kind of getting, those loans are getting, kind of pushed, the need for capital to be able to come in and provide, kind of a solution to pay down senior lenders, replenish reserves, provide capital at, kind of the asset level. That's where groups like us are, kind of really coming in. And I don't see that changing, kind of anytime soon. So I think if we look over, kind of the medium term, like unless you see more selling, capitulation for, a lot of the deals that were done over the last 4 or 5 years, most real estate lenders, like they're very full on their commercial real estate exposure. And so until you see some of that, kind of push through the system, you're not going to see lending go back to the way that it was, kind of over the last 10 years.
Yep. Can you give me an example of a deal? Like just like what you solved. So give me the problem, right? And then give me the solution that you guys kind of figured out relative to it.
Yeah, I would say no two deals are the same. I mean, every one of our deals is, kind of unique. And again, that, is part of why our strategy really thrives, is the fact that we don't, kind of subscribe to having everything be very uniform and commoditized versus, looking at, situations that are typically mispriced. There's some kind of unique angle. There's some level of complication. But I'll give you an example of kind of a deal that we did recently that I think highlights kind of why Mavik and kind of how the opportunity set came to us. So we had a real estate a relationship with an existing partner that we've done 5 transactions with. Their business is they build kind of Class A multifamily. Once it's kind of those buildings are built, then they finance long term with agency debt. So kind of Freddie or Fannie. Now, their business is that they're long-term owners. They own, kind of 1,600 multifamily units all throughout kind of Washington State. And so we were talking about, kind of some of the pain points that they were having in their business. So one of the big challenges for them was, they had started, kind of a number of construction projects that were, started, kind of in a very different interest rate environment. Now, those deals, as they're, kind of getting either completed or now in lease up, they're refinancing those to kind of long-term agency debt. Well, the issue for them is that given where interest rates are, agency debt sizing is significantly lower than what it was when they actually did those those deals. And so in order for them to refinance from their construction loan to kind of permanent financing, there's effectively a gap in the capital stack of anywhere from kind of $2 to $4 million that's needed to make those refinancings possible. So what we did is provided them a $25 million credit facility that was a highly structured deal. The primary source of collateral was these 4 multifamily assets, which at the time that we closed were at 90+% occupancy. We were at kind of 1.5 times kind of DSCR. But the way that we structured is they also pledged to us the cash flows of the 1,600 kind of multifamily units that they own. And so if you kind of factor in the 1,600 multifamily units, we're at over a 10 times DSCR. That's at 15%, 3 years of kind of call protection. Now, why would kind of our counterparty choose to do that deal with us versus what their alternatives are? One, it's kind of very tactical capital that's kind of needed given kind of the environment. If you look at what their options are, is that they could sell buildings today, but they that's not their business. 2, that they would be selling at a time where they think valuations are depressed. They could bring in a JV equity partner that could kind of help recapitalize those deals, but that's going to be highly dilutive. That JV equity partner is going to want obviously a significant kind of part of the upside. Or their third is that they do a highly structured deal with us, gives us a lot of the downside risk mitigation and things that we look for, but allows them to maintain the upside, kind of optionality.
Yep.
And so if you look at I'd say, kind of a very typical transaction for us that's highly structured, very tactical capital, relationship-driven sourcing, a counterparty that we have, the confidence in their ability to execute, and we know that, it meets the kind of characteristics of the things that we look for.
Yeah, and then how do you get your capital back at that point, right? They're not really big sellers, right? They're long-term holders. You're solving a complete problem for them, and obviously they're willing to pay for that, right? Much more than what you would traditionally get. But what's the outcome like? What's the duration and maturity of that line of credit to some extent, or when do you guys get fully paid off?
Well, we like situations like that because you actually have a lot of optionality in terms of how you can, kind of ultimately get repaid. One is just going to be through either, long-term kind of the refinancing of kind of the real estate assets, and then, we're able to exit that way. But also when you look at kind of the durability of the cash flows and the high velocity of the cash flows, that's a situation that you can see kind of clear line of sight to how your interest gets paid, but also you have the ability to kind of self-amortize your principal down. And I think that optionality of, kind of what happens if, kind of path A doesn't work, is there a path B? Like that's one of the ways that we're kind of always thinking about how do we make sure that we have, kind of capital preservation.
Yeah.
And so that's why we like to invest in situations where there's a lot of predictability in terms of the kind of cash flows that gives us, kind of the line of sight to how we get both return on capital, but also return of capital.
And you think if the market environment necessarily changes, they would try to refinance you out with traditional means at some point in time, just to save on spread?
I think the answer to that is yes, but also, I mean, because there's so much structuring that goes into our deals on the front end, like we want to make sure that we have, kind of the appropriate runway. And so one of the things you'll find with kind of our strategy versus, much more kind of traditional kind of private credit that, is much more what you see from, kind of traditional debt funds, mortgage REITs. Like those businesses are beta businesses where they're typically price takers. They're focused more on commoditized type of transactions. Our business is an alpha business where we're focused on outperformance. And so that's why like we're looking for those type of pockets of opportunities that give us, the right duration, they give us the right yield, they're highly structured, but they're also, kind of tactical capital.
Yeah. Now, how do you find these borrowers, right? I know you had a relationship with this particular example, but how do they find Mavik, or how does Mavik find them, right? And that's probably like, there's a lot of folks out there, maybe not doing exactly what you guys are doing, but there's a lot of people out there. How do you source those guys, or how do they find you? Or
I would say there's a couple of things. I mean, one is our business I just mentioned, it's an active business. We're out there, constantly looking for, kind of the opportunities, and it's a offensive approach where we're looking at like where capital flow is not going, where are things that we can offer that a lot of our counterparties or other groups cannot offer. And so our strategy, which is, it's really going to thrive in periods of dislocation, things are uncertain, capital availability is low. And, the flexibility to how we invest is such a massive, competitive advantage because very few groups actually do that. And so the ability for us to craft a custom solution versus, having things that fit with inside a perfect box like that, really thrives in kind of periods of dislocation. I think the other thing is if you look at the size of transactions that we focus on, which is that typically kind of $25 million, like that size is going to be below the radar of a lot of our larger peers. Now, as a platform, we've transacted with over 150 different counterparties, and that's from real estate operators, banks, institutional partners. And so while our strategies are very kind of flexible, nimble, go where the best opportunities are, there's also a level of kind of roll up your sleeves, like you said earlier, like we have to sift through a lot of stuff, and that takes a lot of hard work. And so, that's where, kind of our platform, our team, like we're incentivized to really find those, kind of diamonds in, the rough that may get discarded for superficial reasons. They may feel like they're a little complicated. They don't fit with inside kind of a perfect box, and we can look at them, kind of unconstrained and figure out like how do we create the right structure that meets our, investment guidelines.
yeah, obviously underwriting is key to that, right? For your perspective and your team's perspective to value those particular assets and make sure that you're protecting your principal and generating a return for investors at that point. But when you look at those type of transactions, like what types of returns are you, like what's your baseline type of return that you're trying to achieve when you look at a particular transaction, meaning, is it worth our time and effort to go after this particular borrower and us lend to them versus something just pretty standard?
Well, one of the reasons why we're so focused on kind of the relationship-driven sourcing, one, it allows you to see, differentiate opportunities that are typically not going to be, more auction style. So it allows you to obviously be, kind of, you're investing in situations that are less price sensitive, but also you're just seeing kind of consistency of deal flow. And I think that actually really helps you, to kind of invest throughout a cycle versus, more moment in time. And so, our business, obviously, we've invested in over 160 different transactions. We've had over 120 realizations. So, we're not tourists to this business. Like, we obviously understand what we're doing and have, kind of a lot of experience. But to your point, like, you have to have, kind of consistency in terms of how you invest. And so, where our investment standards are the same regardless of it's January or March, or interest rates are low or interest rates are high. But what that means is that, our deal flow is going to be more episodic, and sizing our capital base, the opportunity set, is really important. And so, we very strongly believe, like, you have to be able to size your capital base up and down based on the environment and, the opportunities that are around you. And so we're typically targeting situations that are kind of net 15 to 25%, kind of IRRs, and
Yep.
Have a little bit longer duration, that we're also balancing that with, kind of total dollar profit, given, how much structure and things are involved in the front end, that we want to make sure they also have the right amount of runway.
Yeah. I always have to ask this question, like when you look at the public markets, like, this doesn't seem like you could actually function in the public markets. Is that accurate?
Well, we invest, in public, private, debt, equity, and
Yeah,
so
sure.
and the way that we view it is that, we're effectively valuing the underlying assets and the collateral the same way. And I think
Yeah.
one of the benefits of having that kind of vantage point is that there's moment in times that things get mispriced for, completely superficial or not obvious reasons. And so the ability to actually have that flexibility and say, public markets right now are, kind of very undervalued because, commercial real estate is out of favor, or you have this specific asset class that may be more misunderstood. That allows us to, again, focus on the best opportunities, and, we never have any forced investing because we can be, truly kind of patient, disciplined, and it gives us also very large hunting ground. And
Yeah.
so I think that ability of saying we can have a really large kind of funnel, but then we can, kind of narrow it down to the areas that we feel like are the highest conviction.
Yep. I'm a glass half full guy, but where are the risks associated in these structured finance transactions relative to real estate? Like, where would you say that people would make a mistake, or where do things go wrong as it relates to this? Like, and then what does that outcome look like? Right. That's the kind of the question, right? Like, I think you and I both agree that there's a great opportunity in structured right, great asset, great borrower, great credit, like a lot of things there. But where do things go wrong, or unevaluated properly? Like, what's the downside component to that? Like, we got to look at both sides of it. For us as investors and everyone listening and watching us, they want to know, okay, it sounds really, really good, but where's the risk?
Yeah, I think there's a couple things. One is, I think if you look at the, kind of typical kind of real estate debt fund, or more of the private credit model, like, I think that model actually has a lot more risk than people think. And so when you look at it and say, kind of lower returns means, kind of lower risk, and, you're typically focused more on kind of first lien, like, that feels like it checks a lot of the boxes.
Yep.
But if you look at the type of transactions that a lot of those groups are doing that are highly, highly commoditized, you're typically winning deals based on, kind of auction style and very much on price, or
Yeah.
on kind of looser covenants, and then you're financially engineering your way to get to these, kind of low returns.
Yep.
I think that model actually has a lot more risk than it's on the surface. And so why we focus in areas that are less commoditized, they're not as well, as trafficked, where capital flows are not necessarily going, is it allows us to actually create the type of structures that, like, we don't have to be so susceptible to, kind of more macro environment, commercial real estate markets, credit markets. And that's a big part of how we actually invest with such a big margin of safety, is that we're not doing what everyone else is doing.
Yep.
And I think that's, there's a lot of risk, I think, that's on the surface that you don't necessarily see until something goes wrong. And I think, you saw a little bit that, over the last, kind of few years, which is in, the banking system. You've seen it with a lot of alternative lenders. And I think the longer this environment, kind of continues to go, people can, only hang on for so long.
Yeah. What about leverage? What do you think about that as it relates to Your transactions or just in general?
I think it's very dangerous, and I think you see that with, again, more the kind of traditional private credit model. And you see it a lot in
Leverage on leverage.
leverage on leverage, and those one of those things that don't necessarily show up until something goes wrong. It's the classic Warren Buffett is you don't see who's swimming naked until the tide goes out. And I think leverage is one of those things that people feel like it's there, but they don't pay as much attention to it. And so much of our business is, again, like we're trying to focus on how do we have a level of predictability to things that we do, and you have a lot of leverage or things that can obviously sink the ship. Like that, to me, can create a lot of business risk. And so we don't really kind of subscribe to that model. And one of the reasons why we're typically not using leverage in our deals, we don't have any fund level leverage. Like that's not our business.
Sounds like you don't need it either, right? Like you generate a pretty solid return with a really good collateral backing of a hard piece of asset usually.
Hard
Right?
assets, durable cash flows, a level of predictability to things that you're investing in. And so we're not swinging for the fences. Our business is about kind of stability. It's kind of how do we make sure there's a level of predictability, and that's why we're so focused on situations that kind of meet those characteristics.
And you're not loaning to owning, right? Like you're loaning to receive your principal back for the most part, I'm assuming.
We definitely are. So like we want to see our borrowers succeed. So like we're investing with counterparties that we have high degree of confidence in their ability to execute. That they have the right type of incentives. Like, and I gave the example earlier, like of kind of the group in Washington. That's a kind of regional kind of real estate operator developer with kind of a real balance sheet specialization and kind of a certain property type. That's very typically kind of who our counterparties are. Now, as a credit investor, like while we're not kind of loan to own and we want to see our borrowers succeed, every situation that we're going into, we're underwriting as if we're the owner. And so we want to see, like, do we feel confident in the business plan? Do we feel like we're at the right type of basis? If something goes wrong, does our team have the skills and the experience to be able to step in and kind of correct course? And we have a 34-person team. We have 12 people on our investment asset management team. We do everything in house, and that gives you a lot of confidence that, like, if something doesn't go kind of as planned, that we can actually step in. And I was talking earlier about kind of my experience where I started my career as a real estate operator developer. And so that also gives you the confidence that if something doesn't go as planned, like I know what to do. And I think for a lot of investors over the last kind of 10 plus years that may not have that type of operational experience, if something goes wrong, that obviously can create a lot of challenges for you.
Yeah, and it seems like you guys sit in a pretty commanding position in these stress-distressed environments that you don't have to light things and lighten up on certain things like maybe other people who have to put money to work.
Well, I think part of that is the understanding the model, right? If you're focused on, kind of volume and scale and you're going to really be more of a beta business, then you're going to have to do those things to get transactions done,
to compete, right?
To compete. And so if you're trying to compete and you're focused on volume and scale, like you have to do that by necessity.
Yep.
Versus our business, which again is an alpha business, like we want to stay away from those situations where we don't want to be focused as much on volume and scale. Like we want to focus on the best opportunities. So there's obviously going to be times where the opportunity set is going to be much larger, and there's going to be other times the opportunity set is going to be smaller, and that's why kind of sizing your capital base to that is going to be really important.
Yeah, that's fantastic. I mean, seems like a great opportunity now, and hopefully we continue to move forward. But I appreciate your time, and thank you very much for spending a little time and talking about structured credit and structured finance and real estate debt.
Absolutely. Thank you so much. It was great to be with you.